Hello, Matt. Joe Walsh, Lepidico, Managing Director. Have been since 2016. Lepidico is developing a vertically integrated lithium project from mine in Namibia, where we're also building a concentrator to find chemical production in the UAE using our proprietary process technologies. We've been on a 10-year journey, and we're now right on the cusp of completing front-end engineering and design and looking at transitioning this project into construction and then operation.
Joe, good to have you back on. Good to have you back on. Well, look, I mean, I think it's true to say that the lithium thesis is going strong. However, if I look at the response to last press release you put out, I'm not sure the market gets it. So do they not think that you're going to be able to insert yourself into that ecosystem? What's going on?
I think that, well, firstly, that the overall market conditions that we're in are pretty challenging right now. But I do think that, the announcement that we just put out, there was a bittersweet element to it, a lot more sweet in my mind to any bitterness. We've spent most of this year looking at upgrading some of these inferred resources in Namibia. So this is resource definition work. This is not exploration. They're defined, albeit inferred resources. We're upgrading them. We've got some brilliant results, much better grades, much better widths than we envisaged that we would get based on the historical drilling. And that's captured in the announcement. We've done some preliminary mine planning on this. We've got a pit optimization. Very low strip ratio as well. So, that allows us to get a little bit of a sense for how low cost the mining is going to be here. The grade indicates that we're going to have some of the best in situ material at Helicon 4, which is the name of the deposit. So this is going to come into the mine schedule reasonably early on and displace lower grade, higher strip ratio material. We all know that that has a massive beneficial effect to valuation. So this is why I say there's a lot more sweet in that announcement based on this resource definition work that we're doing versus the extra 2 months it's looking like it's going to take to complete front-end engineering and design for the chemical plant. Now, I've been in touch with several analysts over the last couple of days, and their feedback is that's inconsequential in this market and also in the greater scheme of things.
But it's not inconsequential in terms of you burning through cash every month and retail investors looking at this and going, oh man, you're just stringing this thing out. So why the delays? Let's start with that and then maybe move on to what does that cost? And if you can back up the inconsequential claims by the analysts, what's the upside by doing that for you?
Sure. No, it's a really good question, Matt. So I think that first and foremost, Lycopodium has the 2 EPCM contracts for the concentrator in Namibia and for the chemical plant in the UAE. All of the concentrator work has been done well. The feed is closed out there. The focus is on the chemical plant, and no one's ever built one of these things before. It's purely hydrometallurgical. It's not complex with a pyrometallurgical front end like a spodumene plant, but it is a proprietary process technology, and we've got to get it right. And we've spent a lot of time working with not just Lycopodium, with the architects of the process technology, Strategic Metallurgy based in Perth, excuse me, and also the independent technical engineer for the lenders to this project, BDA. And so between the 4 of us with Lepidico as well, we've been working out the best process route here. And there's been a couple of areas where we've actually put in some surge capacity. So earlier on this year, the process did change a little bit. That all got bedded down around June. And Lycopodium has then been focused in on completing the control estimate front-end engineering and design. All you have to do is turn the news on to see how challenging markets are for any kind of materials, equipment, like supply chains are under some real strain. And when we came to look at the good work that Lycopodium has done here, it was evident that there was some real opportunity to be able to locally source equipment and materials within the UAE. There's a huge oil, gas, and petrochemicals industry there, very well established. Some of the construction contractors there are big organizations with enormous purchasing power. That element had not been baked in to the work that had been done to sort of late August. And we saw enormous potential there. Remember, we've now got an executive general manager on the ground in the UAE that's built 2 chemical plants in the same industrial park that we're building on. So all of that expertise is now being embedded into the final stage of completing front-end engineering and design. We've also got our own man on the ground in Brisbane who's based out of Lycopodium's office. We didn't have that until 6-8 weeks ago. And during COVID, it was very difficult to be recruiting people and getting them to be working in locations like that. So I think that there's some legacy issues. I think that where we stand now is we've addressed all of those legacy issues that we've had from COVID. We've got the right people involved, and I think it's a very solid date to be completing this feed in November now.
Right. So there's a few things we're going to pick up. So legacy issues due to COVID, not because management's made some bad decisions in the past. Is that what you're saying there?
I think so. We could have put someone in that office maybe earlier. I don't think it would have necessarily been the right person. Trying to recruit senior executive people when you can't even meet them is not straightforward. So, I think that we've expanded the executive management team. We've doubled in size over the first half of this year, effectively. And we couldn't do that during COVID. So I think that it's, as we've come out of this, we've built the team. I think that we've got absolutely the right people involved. And this is a tough market to be getting skills. I think we've got fabulous skills. And that is testament, I think, to the business strategy.
Yeah, it's tough for everyone. Okay, you're all going through it at the moment, but that's why we're investing in these companies, right? We expect the teams to actually do what they're paid to do. But let's go back to the inconsequential, and not your words, analysts' words, but what is 2 months, or what are you allocating in terms of the additional cost to you by stripping this out or prolonging this by another 2 months? How inconsequential is it in terms of dollars?
So the additional work's about $1 million, just under $1 million.
Okay. And the upside, then get to the upside, because that's the interesting bit. Like if it's $1 million and it allows you to capture more value, I'm all in. So what's that number? Have you put a number on that yet?
So we've certainly got some targets as to what we think can be the benefits of local sourcing of materials and risk management in this as well. Part of what we're looking at here is, rather than be getting materials and equipment out of Europe, where there's obviously all sorts of challenges going on right now, is locally sourcing as much as possible. So there will be, I think, capital benefits here. Vis-a-vis not doing the work. There's certainly risk mitigation. And then the other part of it, we cannot lose sight of the resource definition work that's being done. In 2 months' time, we will have measured and indicated resources on a number of these areas that are currently inferred. We'll be able to have those come into the mine plan. The work that we've done so far shows that it adds an extra 6 odd years to the project, taking it up to 20 years of operating life on very, very good grade material with low strip ratio.
Okay, Joe, before we go there, Joe, I want to do a service to everyone listening to this, and I'll make sure you've explained it the best way possible. And I want to stick with the front end engineering on the chemical plant, right? You're saying that all these savings, you spend $1 million over the next additional $1 million over the next 2 months, but you will spend a lot less on your kind of capex and your equipment manufacturer and sourcing. Is that where the only gain is? Does the new design factor in, I don't know, a more efficient process, a more output, or anything like that, or is it just all of that kind of front end bit?
So the design has already been locked down. The design was locked down back in June.
Right.
What we're going to be doing here is more detailed stuff. There's going to be some work looking at sort of repositioning this tank to reduce that piping run. So that's all sort of some more detailed engineering that's being pulled into this phase. So that's smaller stuff in the greater scheme of things.
Okay, but you're spending $1, you might save $3, you might save $5. It's that kind of mentality. That's what you're working for. And when can you give guidance to the market? Would it be when the FED, the feed study is done and complete?
Yeah, we're targeting that for November.
Okay.
We got a board meeting in the latter part of November and our AGM, and completion of this body of work. We discussed it at length with Lycopodium, and it's scheduled to be completed ahead of that board meeting.
Right, but and will it include numbers? Because obviously that's it's an engineering and design phase, paperwork stuff. Is there a kind of costing component that goes with the same study? And will you be able to show the market and say, look, we were delayed, it cost $1, but we've saved $3? I mean, are you going to be able to give us that? Because there's a kind of trust component. Do you know what I mean?
Yeah, absolutely. I agree. So the absolute answer is yes. Along with the front end engineering and design is the control estimate, which gives us the capex for the project, and the control schedule, which tells us the time it's going to take to build the project. And I think, as everyone knows, vis-a-vis a definitive feasibility study that was done in May 2020. There are inflationary pressures that we've experienced, but you look at BMI's forecast for the lithium price, that's increased significantly as well. And we've said this in previous quarterlies. When you take into account inflationary effects both on capex and opex, coupled with more recent price expectations for commodities, we get a net improvement in valuation. And the resources are only going to support that further.
Brilliant. Okay, so that side of the business, you're getting into the weeds there. In November, we're aiming for, and then with regards to the actual decision, you're at a point where you can make a decision materially around timing and who you source this from, and there's a kind of there's a process that you've got to go through there. How are you incentivized to move this forward? Do you need to wait for market conditions to change at all? Do you need to be sure on your commercial terms before you can, press the green button there? How does it look forward? What does it look like going forward?
Sure. So it is a tough environment. There's no doubt about it. I think you've clearly recognised that, but it shouldn't prevent us from moving forward. So I think good quality projects can still get developed in more challenging environments. And one of the advantages of having very solid lenders is the fact that will satisfy a very substantial proportion of the capital funding. And we've been talking about this for several years now. We're well advanced with the US government's International Development Finance Corporation as the cornerstone lender for the upstream part of the business or the development in Namibia. And then more traditional commercial lenders for the UAE piece. We're also looking at there's some other options, interesting options there for funding the UAE piece as well, which we're exploring. So I think these kind of lenders aren't perturbed by the sort of current market circumstances. That's more of an equity thing. Yeah. So these lenders are thinking much longer term, sort of 7 years, 10-year payback, 10-year lending on a shorter payback of probably 3 to 4 years. That's where they're thinking. So, I think we've got exactly the right funding strategy here. We're dealing with some very, very credible organizations that are then going to give credibility that can be leveraged for the equity component.
Right. And you were talking about US funding. We've talked about that before. But we kind of let's divide this up, because you've kind of got the UAE component. You're in a kind of industrial park there. So people looking into that jurisdiction right now, given what's going on in the world, and the UAE seems to be keeping nice and quiet and out of the way of things. So there's going to be no reticence from any Western commercial investors, funders, in putting money into that part of the world, and if that was the case, would you have to look local? And I say that because we've been speaking to groups who partially sell offtake into China, and they've been encouraged by Western commercial lenders not to do that if they wanted to get any funding from the West. So there's a kind of slight potential bifurcation of markets, especially around battery metals. So what are you saying?
You're exactly right, Matt. I think that geopolitics, particularly in the battery materials space, has really become very evident over the last couple of years, and I'm very pleased with the jurisdictions in which we're operating here, because they're pretty neutral. Namibia and the UAE, and particularly focusing in on the UAE. Very stable government, some of the world's lowest and most stable energy prices. As you mentioned, we're building an enormous industrial park, so there's this benefit of this enormous shared infrastructure that we get. And they're being very progressive. There's a big commitment now to be bringing on commercial quantities of green hydrogen. Like in a couple of years' time, the world's largest single-site solar PV 2 gigawatt power station is going to be coming on stream, and the majority of the power from that facility is intended for green hydrogen and green ammonia manufacture within the Kizad Industrial Park, where we're going to be building. We're looking at future-proofing our plant by putting in a hydrogen-enabled boiler. So as soon as we can switch that thing off over from natural gas to green hydrogen, our greenhouse gas emissions will go from being probably about 25% lower than a typical vertically integrated spodumene project to best in industry. So I think that in 5 years' time, people will look back and they'll say, how come you made that decision to build in the UAE? Because that is just such a fabulous place to be doing business.
Well, it's interesting in the concept. I come back to your analyst comment, and I have to say I kind of agree with them in the sense that the 2 month delay is inconsequential in the context of the total spend, and if it can. If it's slightly more efficient, then that's always a good thing. But there's also a kind of conversation that's had with, and maybe you have the benefit of, and I certainly have the benefit of when I talk to, battery manufacturers or OEMs, people in the sector building out this massive infrastructure, that they do plan longer, they do think longer, and I guess the companies that can insert themselves into that ecosystem and think and plan and finance the same ways, I've got more chance of success. So I'm looking to you, and I've got to ask the question, which is, in Namibia, you've gone through a process of upgrading the asset in Namibia, higher grade, longer life of mine, all kind of good stuff, but it's still inferred, right? What more do you need to do to that project to make it attractive, to make it investable and fundable from outside? Because you can't take too many shortcuts, really, can you?
No, absolutely we can't take any shortcuts. And I think one of the things that Lepidico has done incredibly effectively over the course of the last 6 years is effectively manage business risk. It's one of the reasons why we're bringing a more modest scale project on with phase one. It's all about risk management. Like we could have drilled out additional material and got a bigger inventory and gone bigger, but risk development and operating risk grows exponentially with scale. So we're always mindful about business risk and managing it effectively. And so these additional resources, they were inferred. We've now done all of the drilling. It's complete. We've got the assays back. We know the drill density is sufficient to be able to get the resources into measured and indicated category, just like at Helicon 1, just like at Rubicon. And so that resource estimation work and so the new mineral resource estimate is scheduled for later on in October. We've already done the preliminary mine assessment based on the latest drill data. And so we've already got a preliminary pit optimization. That mine planning work, mine design work will then be done. Helicon 4 is a relatively small scale pit. So by early November, we should have an ore reserve and be able to be factoring this into our life of mine plan and the overall project.
Right. Do you think the market do you think investors understand the business model in its entirety in terms of trying to move, downstream into, chemicals? Well, I can see why you want to do it, because it makes total sense, because you kind of potentially get a re-rate from being a miner to being a chemicals industrial company. But what's the reality of where the value of this company sits today versus in, let's say, 10 years' time? What do investors need to understand where you're going?
So phase one is all about proof of commercialization, managing risk, demonstrating the commercial viability of these process technologies. 10 years' time, we're going to have looked at a phase two project. We could even be at phase three. Like, we've already sold one license package to Cornish Lithium. And so, by then, we should be looking at royalties on the horizon. In certain circumstances, we could consider other licensing arrangements as well. So, that's a whole other part of the business here. And what we have seen over the course of this year is much greater interest in lithium-micas. And it's not just lepidolite. There are other lithium-mica minerals like zinwaldite, polylithionite, lithium muscovite. Our process can treat all of those. And so what we've had multiple inbound, unsolicited inquiries with regard to our technology. And the way our thinking in this regard has changed is we're not looking at necessarily trying to partner on the upstream part of on these other deposits. I think we can be looking at developing the world's first market for lithium-mica concentrates. And we can have maybe a concentrate stream coming out of Namibia into a phase two plant that's somewhere else in the world. It could be back in the UAE, it could be in Namibia, it could be in the US, and having third-party concentrate streams coming into that. And so we want to be vertically integrated. We see significant benefit in being vertically integrated. It reduces volatility throughout the economic cycle, because at some points in that sort of lithium pricing cycle, you have concentrates like now, which are at a premium. And for the non-integrated converter, say in China right now, they're having to pay $5,000-6,000 a ton for spodumene concentrate. That equates to maybe $35,000+ a ton on lithium carbonate equivalent. So those converters in China, they need $45,000 a ton, maybe $50,000 a ton, just to turning a profit. And so on that basis, the spot chemical prices aren't actually that high right now. What I think that we'll see in the fullness of time, as new spodumene projects come on, is we might see spodumene concentrate prices soften, particularly if there's a lag in new converter capacity coming on. Okay? Being vertically integrated really insulates against that volatility in concentrate pricing and the transference of value in product from concentrate to fine chemical.
Well, let's talk about that, Joe, because basic economics 101 I want from you here. So I want to understand is, are lithium prices in all its derivatives, is it really truly sustainable? Because there are so many lithium companies talking a game of getting into production. Where I've had one come on here and say we can supply the world's lithium demands just from our one project, right? And you've got some existing big producers who can turn the tap on and pump out more lithium into the marketplace. If all of those people are to be believed, we've got more than enough lithium, and oversupply means one thing: it means lower prices. So what am I missing?
So Matt, I'm going to in a minute ask you this very question back. Okay, so 2021 lithium supply was maybe 400,000 tons. Depending on which commentators you listen to, by 2030, like the US Department of Energy is saying 3 million tons of demand is going to be required. BMI is at around 2.3, and they're saying that the industry isn't going to get close to supplying 2. Okay, let's look at this from the perspective of the cost curve. So the cost curve is this big in 2021. The x-axis by 2030 is going to be 5 to 6 times longer. So you've got these incumbent producers here with all of their sunk capital, and you've got all of this new production that needs to come on stream, okay, which is going to be, it is yet to be sunk capital. The inflation that we've seen over the last couple of years is all going to be baked in. And then you look at what some of these projects look like. So what's the top end of that cost curve likely going to be looking like? Well, I think we've got some visibility on that this year with some intentions in China to be bringing some lepidolite deposits on there that are super low grade. Right? The capex for one of the projects is estimated at $4.6 billion for 100,000 tons of lithium carbonate equivalent. Okay, so, and this is really low grade material. Like my understanding is it's about 0.25% lithium oxide. That's not too far off our lower cutoff grade. Okay, so it's almost certainly going to be right at the very top end of the cost curve. They're roasting. If they're using fossil fuels for process heat in the roaster, it's going to be the dirtiest lithium in there probably that's going to be produced in the world as well. Okay, so I would suggest that these operations are likely going to become the industry's swing producers if they do get up and running. They're going to be right up in that top decile of the cost curve. And to be able to have those projects at the margin, I think that we're probably going to need to see $35,000, $40,000 a ton lithium chemical prices in real terms. So, all of these new projects are going to be coming on. There's going to be a mixture of some brines, obviously more spodumene projects, some sedimentary hosted. The reality is not all of them are going to get there. Like we're hearing about permitting, we're hearing about infrastructure. The ESG requirements are only getting more stringent, particularly for Western producers. Those are all headwinds for new projects. So a lot of these projects are only going to take longer to get into production. So demand, I think, is going to continue to be accelerating. Supply is going to struggle to keep up. So, Matt, what does the upper end of that top quartile of the cost curve look like by 2025, 2030? Because that's going to be what's going to be supporting prices.
It's look, obviously mining. I would say mining is very difficult. There are lots of challenges. I think there are lots more challenges these days than there were. I think around permitting and licensing and the environmental component, the social component, ESG, which is I think slightly fading, or its sheen has come off somewhat, but it's still badged as such. I would argue it's always had to exist for good companies. It's tough, right? And not all CEOs are to be believed. So will all the demand that's being talked about come online? I doubt it. There's a lot of pressure from all corners on that one. I think that will put pressure on supply for sure. The question of how close can it tag along behind demand, I don't know. It's the great unknown. But I think what we're all going to agree on violently is that there is going to be a delta between those two numbers now and for the imminent future, I suspect. So can I ask one more question of you, which is, why is the integrated model any better than just pure mining? Just like I've got a good lithium deposit, I'm going to mine and I'm going to make sure I do it efficiently and effectively, and capture the biggest margin I can. Why put this complicated layer of chemical plant on top? Doesn't that confuse the market? Does it make things more difficult for you?
So it might confuse the market, but that's not my concern really. Like my concern is to be developing the most robust business that we possibly can. It's about participating through the economic cycle and getting as much return as we possibly can, and we've got the technologies to be able to do that. Yeah. So what we see through the lithium price cycle is value transfer from concentrate manufacture to chemical manufacture at various points in the cycle. And we saw this in the last cycle. So when there was a lack of converter capacity, a lack of concentrate capacity and a reasonable amount of converter capacity, then we saw very strong spodumene concentrate pricing. As more concentrate operations come on, and the barrier to entry to produce a mine and a DMS plant is a lot lower than build a large, complex downstream chemical plant, particularly if it's spodumene with a large roaster and calciner associated with it. So once there's an oversupply of spodumene concentrates, supply demand, concentrate prices decline, but you can still have prevailing chemical prices elevated because there isn't enough converter capacity to satisfy actual chemical demand. Okay, so that's what we want to participate in. We want to be participating in both parts of this equation through the lithium price cycle. It means that we have a more robust business throughout the cycle, and in the fullness of time, we probably will see supply and demand start to meet. It's difficult to see where it's going to happen this decade, but then there will be pressure. But the greatest pressure is going to be felt by the non-integrateds. So those that are just mining and producing a con, or those that don't have their own upstream asset and they're just doing the chemical conversion. By having both, it is a great risk mitigator.
Joe, appreciate your time today. Thanks for coming on the call.
Thank you very much, Matt. Good to see you again.